You know something? Remember, there are no shortcuts, son. Quick buck artists come and go with every bull market, but the steady players make it through the bear markets. You're a part of something here, bud. The money you make for people creates science and research jobs.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 10th, 2023. S&P 500 currently sitting at 4083. I'm David Zarling. I'm here with the third Kelsey brother, Ian McMillan, ready to talk stocks. And wouldn't you know it, it's episode 150. Nice round number. Everybody loves it. Is it as nice as a nice round number like 4180 on the S&P 500?
Oof. Once again, many trips to 4180. Got there Monday and Tuesday, I guess.
Mm-hmm. And why is this important? Why is 4180?
Or just Tuesday.
I think anybody who's listened to this podcast
for
10 months.
How long do you think, Dave?
10 months, 10 months. We've talked about 4180. Like if I
started last June.
Yeah.
Wow, really?
Mm-hmm.
Started last March and May.
Yeah, where it failed. It was support, then failed.
Then we got up there for the June consolidation. That rolled over. Got up there through that July-August rally. Did get above 4180. Right into the 200-day.
In August.
Sold off.
Yeah.
Rejected the under. So there's 4180, and then there's kind of this also 4080.
Yep.
The underside of that.
Important range.
And
where we are
again,
right now.
With no decisive move in either way. I think it makes sense to consolidate given what stocks have done. Yeah, since October, but also since the beginning of the year.
For sure. I mean, consolidations aren't a bad thing. It all depends directionally where they break. And I know that we could have Pratty pull his hair out if I asked him to go through all our podcasts and put together a soundbite of all the times we talked about 4080 and 4180 on the S&P 500 over the last 10 months. I don't think we'll do that to him.
You could probably just search our notes.
Yeah.
Or pre-podcast notes.
Yeah, it could work. But it's an important level. I don't mean to make light of it from a podcast perspective. It's a reality that that's where sellers have shown up in the past. The idea that we were just going to blow through 4180 on something like the S&P 500, that would have been information if it had done it. I'm not saying
that would have been a big eye opener.
Right. But we also don't get to be surprised that selling showed up recently in that area because it's a historical market mile marker, as you alluded to. And I think it's important to remember because you kind of talked a little bit about like, we know that October now is a bottom, could turn into the bottom as we move forward in time. And if breadth expands and we move higher, more likely that is the bottom.
Mm-hmm.
And the move we've seen since January, how could this possibly be happening, Ian, with the backdrop of everybody saying there's going to be a recession?
Yeah, that certainly has been. I mean, the narrative has continued to be quite bearish, even with stocks rallying, and I think every sector positive over the last few months. So is that just to use your phrase? I mean, are they just continuing to stack wood?
Right.
Because and through this consolidation we've had this week, I mean, there's definitely some individual charts that are putting more of the looking to like roll over type of.
Yeah, like can you paint that picture? Like describe that to me. Like more charts.
Broad indices are consolidating, but these are just averages. So there have to be some stocks that have not just consolidated, but rolled over. And there's probably some stocks that didn't consolidate at all and have just kept going.
Right.
But, in the context of where we are, I don't think anything dramatic has happened yet. Like, do we need to have a June 10th to say, okay, the next leg's lower? Or what was that, June 10th?
You're talking about the consolidation that took place
June 9th.
June 9th. And what Ian's referencing here, and the reason why 4080 and 4180 are important on the S&P, is that was a range that was created underneath what had been prior support, turned into then resistance. And on June 9th, it confirmed that by breaking down from that range. And we are at that same level now. And Ian's point is, would that, if we saw another June 9th of 2022, would that confirm potential more downside? It wouldn't hurt that thesis for sure.
It wouldn't hurt. And we are talking about the S&P, and on other major indices, one thing I want to point out is that, so if we use this late May, early June consolidation in the S&P, so that same, and it was at same time period on the Russell 2000, we are above that. So we are just retesting it.
Right.
Right. So there are some, and then you've got the Qs more similar
to the S&P.
To the S&P. That makes sense, right? As an
Mhm.
index, it's more similar.
Yep.
And then the Dow's been here since November. The same spot, basically this 33,500 to 4,000 area has continued to chop around, got up to a little above breakout back in December. Yeah, so it's just neither side has a lot of conviction right now, I would say.
And that's from a broad indice perspective. But when we look at and there's two things. There's an anecdotal, and then it's a market of stocks.
Mm-hmm.
So we have seen 52-week highs continue to improve. Now, some of that is you need to understand what we're actually saying, right? You're looking back 52 weeks. Well, that doesn't mean you're at all-time highs.
No.
Right? If the average stock has been in a correction since February of 2021, I'm going to say that again. February of 2021, indices, yes, since January of 2022. I would say, going back to your point about economy versus the market, how many people, how many news stations, quote unquote news stations, or publications were putting out information in February of 21 that a recession is on us?
Mm-hmm.
So there's been a lot of pricing history that's happened since February 21. Why would we? Because the answer to that is no one was. And that we would move higher from October of 2022 from a broad indice perspective. I don't think we would get to be surprised that the market because it's a future discounting mechanism.
For sure.
I know we talked ad nauseum back during the COVID crash. 150 episodes, believe it or not, we were recording.
Wow.
Going back to the COVID crash, there were people
we've been through some things with our listeners, haven't we?
We have been through some things, and that's an excellent point.
I like that, and clients.
Yeah, yep, clients, listeners, we've been through some things, and I happen to remember during the COVID correction and subsequent rebound how much angst and pushback there was behind some of the bullish evidence that we were pointing out in April and May of 2020. And
Yeah.
I'm not saying we're at that point here. I'm just saying you and I and other listeners don't get to tell the market what to do. Doesn't really care what we think. And if it moves higher from here, even though all the talk is recession talk, well, who's wrong then? Is it the market that's wrong? Or is it the recession talk that's wrong?
Yeah.
I'll let listeners contemplate that over their weekend.
I think they know what side we stand on.
Yeah, exactly. But you pointed out the consolidations are perfectly normal. there's some charts that are holding up, some charts that are rolling over. Some things I think about are that we talked about in the past are like home builders or semiconductors, which are, I mean, I think you'd agree those are risk on areas.
Mm-hmm.
And they're up against resistance or what would be called a place where sellers have shown up before. It would make sense for them to consolidate here. I mean, as much as you and I would love it if every week was just green and every month was just green.
That would be nice.
Right.
Or red. I just want to go in the same direction.
Yeah, whatever the trend is.
Whatever the trend is, let's just keep going in that direction.
Mm-hmm.
And then call me right before it's over and let me know.
But I think of, XHB, home builders between 65 and 72, or we talked ad nauseum about the S&P, or semiconductors using XSD.
Semis, yeah.
I mean, it's okay. Because where are we? I mean, we've talked a little bit about seasonality in the past. You mentioned things being strong since the beginning of the year. This is a post midterm election year, third year in a presidential cycle. Tends to be pretty strong, but not all the months have to be strong. February, right? I think you pointed out yesterday, weakest to the strongest six. Yeah. So like I said, I wish it was green every day, but consolidation is healthy too. No problems, no worries. So where do you want to focus our attention, Ian, for some other, it could be anything. It could be strength that you're noticing. It could be a point that you want to make. It could be weakness that's important to take note of. It could be, we don't really see much change. Anything you want to touch base on?
So one thing I would like to remind everyone that I know there are weeks, maybe red, but I want to keep everyone in check with that we are still coming off some pretty bullish thrust action, quote unquote thrust, right? Now that can be defined a plethora of ways. And there's some classic ones, and then there's, custom things that people like to come up with, traders or investors like to come up with. And some use a whole index of thrusts. And so I just want to keep that in mind of, there might be choppy action, but historically, some of the things we've seen in breadth and price, combined with the seasonality that you mentioned, tend to continue to point towards what could be, and if all these things continue to play out historically as they have, again, we know every year in the market something that's never happened before happens, that it should be it should and could be a pretty strong 2023.
Yeah.
But we've got some big levels to get through. You can't have a strong 2023 if you never get through 4180 or 34,000 on the Dow, or we talk about the Russell, and Russell could go on another, let's say if this is just a little, what the Russell over the last couple weeks, this is just a little throwback into 188, 189, these highs from November. It can go on another 12, 13% tear and just be getting back to that neckline. Think about that resistance. That neckline at 210.
Yeah.
On IWM. That's like final boss level. That's going to be a tough one to get through. So still not out of the woods. We won't be, right. I don't think you're out of the woods till you get to all-time highs. That's just the technician in me, but
right. Well, and you got to take it step by step.
Yeah.
Our clients know our game plan. Below 4180, above 4180 on the S&P, 210 on IWM. You could actually go back. We talked about that level actually for months back in 2022. And you're absolutely right. That's an area of polarity. It's a polarity being, where supply and demand meet and buyers have to chew through the sellers there.
It's a lot.
It's a lot. But if you're going to move higher, that's what you have to have. And
all the stocks that came before did it.
Mm-hmm.
All the ancestors did it.
Right.
So this generation's
if you're going to be a bull,
gonna have to eat the supply or
right.
die.
That's right. If you're gonna be a bull, you got to eat through supply, and that's just the way it is. And we're heading into a circumstance too where across these major indices, you're starting to see a 200-day flatten out. And you look back to 200 periods of trading, 200 trading days, and what's falling off the backside of the data and what's coming in. You're going to see a continuing flattening out. And we know that those type of markets, when 200 days are flat, tend to be messy. And so we should expect that. Like, I don't know that we shouldn't. But when 200 days are flat, and you have basically equilibrium for the past 200 days, you should expect some messiness. And that would make sense coming out of a potential bear into a new bull, that you're going to have that.
Yeah.
But your point,
very flat.
Yeah.
That was super flat. And like we talked about, it's been in the same spot for 3 months, November 10th.
Yeah.
Birthday.
Yeah. Very important. Very important.
Glad I didn't buy Dow with my birthday money. It hasn't gone anywhere.
I mean, IWM's flattening out. Small caps are flattening out.
EFA, foreign stocks.
Yep. And before you get a 200-day to rise, it has to flatten out. And so we've said in the past, before stocks can go up, they have to stop going down. The past 200 days of information averaged as a trend. Before it can go up, has to stop going down. And now we're starting to see this 200-day flatten out across a lot of different things. Things can get volatile and messy during that period. But if it these consolidations continue, it's really about the direction of after these consolidations.
Mm-hmm. Maybe they do roll over.
Right. That's okay.
I'm willing to accept that.
There's a game plan for that too. And that's really what it comes down to, right? Having a game plan versus not. Like, you can buy and hope, that's fine. That's your practice, or that's how you want to help your clients, that's fine. But on the flip side, you could have a game plan that above certain levels you could participate, below certain levels you could be more neutral, and even below other levels, that's a reestablishment of a downtrend. It's okay. So we talked a little bit about broad indices, a little bit of breadth. We continue to see 52-week highs improve. That's a good thing. Bullish percent is at midfield. Is at midfield and in X's. That's good. What about international? And maybe we could tie that in with the dollar. What we're seeing out of that area, because that had a strong start to the year.
Did have a strong start, had a strong end. Like most stocks. Foreign stocks definitely outperformed. They've been consolidating for closer to 2 to 3 weeks. If you look at EFA, EEM, we'll see, China, not amazing. Is China consolidating here? Are we rolling back over? I think if you look at FXI, as long as you're on the right side of 29 or $29 a share, then you could treat this as a, some type of, maybe we create a inverse head and shoulders. I hate to talk about chart patterns on here.
No, you're good. But I think you had some good observations on Twitter regarding just the makeup of some of the emerging market stuff that we've seen.
Yeah, emerging market. I mean, you've had India has really fallen off. I think we all, kind of know why. They got quite a bit of pretty big scandal going on over there. But even if we didn't know why, the chart is the chart. Big relative loser the last few months. And yeah, foreign is certainly stalling out like everything else. It started to stall out first.
And we don't really get to be surprised by that based on the behavior of the dollar.
And frontier markets never had the same. In fact, I'm probably going to put frontier markets in the breakout or failed breakout category. It never looked structurally as good as emerging markets did. Not that it has to, but
Well, it revisited its 200-day on a relative basis, sold off. But your point is, it's almost like, forgive me, marijuana stocks.
yeah, they're
Just
like
never-
I mean, frontier markets are like the junk bond markets of
Oh man, junk bonds.
of equities. Like, you kind of want to see them. I'm not saying that everyone needs to buy crap, but you kind of want to see people buy the
The high risk.
high risk stuff. And you had a great, speaking of that, J&K yesterday.
Yeah, junk
Dave?
bonds. Yeah, junk
Yeah.
bonds selling off at
Look where they're rolling over at.
another area of polarity. This would be a dividend adjusted or yield adjusted chart near 94, 94.50.
Mm-hmm.
But yeah, you're headed into an area of
COVID
resistance.
highs
And they
sold off
and they
again
sell.
at the COVID highs.
But your point
Pre-COVID
is,
highs.
yeah, your point is made. Like junk bonds are the risk on area of credit. Your frontier markets are the risk on area of international. Your micro caps and small caps are your risk on area of domestic equities. And those seem to be hitting some resistance on a relative basis.
Yeah, you talked about microcaps last week.
Yeah.
They made a
And-
good push on late last week. I think it was last Friday.
Right. And I would say on an absolute basis, they really do need to hold this, 115 area.
Desperately. Yeah.
Yeah. And it's kind of flattening out 200-day. And again, this is where things get messy.
Yeah, are we building a base here? Maybe.
And sometimes bases take time. And that's okay.
Yeah, bases kind of suck from a price behavior perspective.
Right. And that's okay.
It's okay. You get the trend when you leave the base.
Right. You get the trend. And that's just it. You can make an argument subsurface. There's been a downtrend since February of 21, but also a mixed trend because you throw the mega caps in there that were still uptrending going into January 22. You have that overall mix. It confuses investors because they see one thing when something else is actually happening. And now you're in an environment where as the base evolves, I shouldn't just blanketly say it's a base. It could just be a consolidation.
It's consolidation. Yep.
Yeah, consolidation, because consolidations, it's really about directionally where they leave. And that's going to be important information. It's good to see all the breadth expansion happening underneath. That's kind of the clue of potential more upside.
Yes.
So we'll see. And
IW, Russell underperformed this week. I could throw that in also, similar to microcaps, maybe building a base relative breakout, essentially. Last Friday, and it's petered off a bit, but kind of another. It has not been large cap growth that has led us the last 2 or 3 months.
Right.
And you can even look that. I mean, when you look at the NASDAQ, when we look at our relative strength rankings in the NASDAQ, I believe I posted them to the Twitter account over the weekend, but it is it's not your Apples and Microsofts and Amazons. There's not household names that like we've seen for the last 3 or 4 years leading the NASDAQ higher.
Right.
And I'm not saying the NASDAQ is a leading index right now. I'm just saying what has pushed the NASDAQ higher since the, October lows, again, using your maybe a bottom. We don't know if it's the bottom. I think there's definitely some people that are pretty adamant that it's the bottom. So far, the evidence would say that might be right. I'm not ready to hop on that train yet.
Right. You just have to wait for more price confirmation. And your point is you're saying from the October advance, it's really, you look at something like an equal weight Qs versus the Qs overall. So equal weight NASDAQ 100 versus NASDAQ 100 itself, which is a cap weighted measurement. It's the equal weight or the things that aren't the large cap that have carried it forward.
Mm-hmm.
And you could also argue since mid-January that's on the rocks. I don't know.
Yeah, it's not, and maybe we're going back, right? And that would be okay. So now wouldn't that be something if we shift away from equities and we go to rates, right? Because that's been one of it would seem most technicians going to tell you rates probably going higher. Bonds rolled over hard this week.
Yeah,
So what does that
bonds.
do to the large cap growth? Or
Yeah,
and today utility is one of the best sectors today, and those are supposed to not do. I mean,
right.
huge moving rate. I mean, bonds the last 2 days absolutely losing steam, and what I would say is, I think a good
After
chance TLT goes back to $100,
right, which
99
then
bucks.
puts you at a TYX or a 30-year Treasury bond around 4.3. And when you look at rates overall, let's use a 30-year rate measurement of Treasuries or a 10-year rate, pulling back into a 200-day moving average and at logical levels of prior buyer and seller interaction, it makes sense that if rates were to move higher from here and bonds lower, and all it was a counter trend move, and the resumption of the bond downtrend continues with rates higher, and then everybody would be like, oh, well, of course the Fed is raising rates. Well, we could have that debate about who's the dog and who's the dog and who's the tail. But your point is made. We're seeing rates turn back up. We're seeing bonds roll over. We talked about junk bonds, the risk on area of credit selling off at a logical level. We have the dollar bouncing on a trade weighted basis at a logical level.
Yes.
And some of that is, we talked international. So if you're going to see dollar strength here, that's going to have some ramifications or a headwind for international. That doesn't mean international immediately goes to new lows, but it won't be the same smooth ride that it was before if we're going to see dollar strength.
Well, and that was one of the big catalysts for this entire equity rally, I think.
Right. No, for sure.
Whether it matters or not, mentally, golly, we moaned about the dollar for 2 years and finally get a correction and markets rip. And we came back to as you'd say, a pretty logical area where you could absolutely expect the dollar. I wouldn't be surprised. And maybe it doesn't hurt stock. I have no idea. Maybe we just go back to large cap growth. Again, I've never been sold on the argument that the dollar is whatever it does is somehow has to be good or bad for stocks. I think it's good or bad for certain types of stocks.
And at certain times.
At certain times, exactly. But I can put down to a great argument about why stocks do great when dollar goes up and why stocks do horrible when the dollar goes up and vice versa.
Right.
There's too many other things going on in the market to just have this very dollar does this and stocks do that type of mindset.
Well, and we've seen since the beginning of 2022, stocks correct and bonds correct, and then commodities join that party in the second quarter of 2022 of correcting. We've seen a rebound since October that, like you said, was coincident with a weakening dollar on a trade-weighted basis. And now, is it possible, right? Because we're seeing tips for inflation-protected bonds, treasuries, those type of instruments also rolling over.
Bonds.
Where's the narrative about higher rates and disinflation? Some would call that stagflation. I don't see any narrative about that.
Yeah, that would be rough.
So we'll see. I mean, time will tell. And this is all happening with where are we at with like an implied volatility? I believe it's higher.
Yeah, I think
like
we're back above 20.
The VIX.
Breaking a rate of trend. I know we're not supposed to do TA on the VIX, but we are breaking a rate of trend. I'm not saying it has to mean anything. And the VIX, it is back to 21-ish. Little off the high, quite a bit off the highs today. Now I could say it's also broken a rate of trend off the July 21 lows of 14. And you want to go through and connect all these October 21, January 22, August 22.
Yeah. I mean, an elevated VIX doesn't have to preclude downward stocks. It just means increased volatility or option premiums. And, there's some level here that coincides with 4180 on the S&P. We don't get to be shocked by that. And so we have to wait and get more information. And for some, that's okay. And for others, that drives them nuts because they want to hear a prediction. We don't have one. We do see with the dollar strength, we've seen commodity weakness in some areas. That's notable. I know Kevin posted a chart today about palladium breaking a horizontal level that goes back quite a ways. At the same time, I know orange juice futures are ripping, and it's about taking all
At $18 for a mimosa. So, yeah, I believe it.
Yeah, right. Yeah, if some Fed representative can bring up lasagna at Costco, we can bring up mimosas for sure. So we just got back from, before we wrap up, Exchange ETF conference. Any thoughts on that?
I think it was great. It was another great learning experience, which is, I think, really what you and I are doing a lot of is learning these first, all of last year, launching an ETF and then getting out there and, building awareness around it. It's kind of that next step. So I think that there's lots of great third parties that were there. It was great to talk to a lot of the people we already work with, like GTS, and maybe some new service providers as well that ultimately will benefit the fund and benefit clients.
And that's really what it's all about, right? It's, we built this ETF for clients. We think other advisors will love it too. Thought it was a good, conferences are always an interesting thing because content could be great, or maybe the content's lacking, but the networking is great. I think this had nuggets of both. And it's some of those conversations that you have. And there's individuals out there I know who may be listening to this that know exactly what I'm talking about as far as providing some clarity to the fog of the unknown. And, during our team meeting this morning, we just talked about Paul Tudor Jones and the desire to let your curiosity run, allow the desire and unquenchable thirst for knowledge and information. And that was part of the participating in that exchange, was get the word out about ADPV, the ETF, but also how can we improve it? And so I thought it was great in that regard, plus hanging out with you, Ian. And I know there were advisors.
It's not a bad place to hang out.
Right. Yeah, I agree. Sunny and 80 is different than cloudy and 25. Let's put it out there. And part of it's mingling with other advisors as well. And I know that I'd like to put out there that, if you're an advisor and you want to learn more about ADPV, you can reach out to us. If you have, for example, if you have questions regarding its listing on your platform of preference, please do reach out to us. That would be great. And otherwise, I thought the conference was a success from a obtaining information standpoint.
For sure.
That, making connections with certain individuals and learning more about how things operate and how we can do it better. Thought it was great. And then, Ian, what is going to happen in your household this weekend?
So, well, my son, it's going to be a big one. Things have definitely gotten awkward. I haven't talked to my wife in 3 days.
So for context for those listening, Ian, diehard grown up Chiefs fan. His wife, Kate, diehard Phillies.
Yeah,
Or not
wife's from
Phillies.
Philly. Wife's from Delco. She's an Eagles girl. I mean, obviously, like most Philly, I mean, it's a whole massive
Eagles.
family of Eagles.
Eagles fan. So what's going on with Connor? What's going on with you
So
said
Connor, yes.
you and Kate are on the
Connor wore
outs.
his Miles Sanders jersey to school yesterday.
Ooh.
I know. So that was kind of a dagger. That was a little bit of a dagger.
Was that planted? Was Kate in charge?
Yeah, I think maybe that was a little flex from mom. But
I
no,
think
it'll
it's
be
great.
good. We're gonna go over and watch it with some friends. It'll be really good. I'm excited. I mean, for our entire relationship, since we've known each other, and really especially since 2017-ish. I think the Eagles won in 2017, right? Beat
Sounds
the
right.
Patriots, and then Chiefs won in 2018, I think, or 2019.
Well, they won. Well, I just want to throw some things out there for our investor friends and for your lovely wife and for you. And that's when the Eagles won in 2018. That was the worst stock year since 2008.
Yeah.
And when an Eagles team wins, and this actually was put together by Ryan Dietrich.
That was down 1,000 points the Monday after the Eagles won.
Yeah. And in 1980, the Phillies won. And there was a double dip recession in the early 80s. 2008, the Phillies won World Series, and there was a financial crisis.
So be careful. As you're saying, be careful what you wish for.
Right.
You want your 401k to go up, or do you want
Right.
you want a championship?
I mean, just be careful. I mean, I know there's going to be some Eagle cheering out there, but I guess if you want a financial crisis, you could do that.
Well, as long as you have a plan to sell, I guess you could root for both.
That's true. I'm just looking for good football, honestly.
I think it'll be good. I think
it will be
real
too.
good.
I think it'll be fantastic. And I really don't have I'm rooting for Chiefs because I'm rooting for you, rooting for Eagles because of, some of our relationships at US Bank, and then of course Kate. So I'm okay either way.
Man. Eagles, I've watched every Chiefs game for years. And for probably the last 6 or 7 years, I've watched probably every Eagles game as well. At least 15 out of the 16, regular season games. I've watched a lot of Eagles football. They're good. They are very good.
Yeah.
They got some weapons. I still think they'd be 16-1 if Jalen hadn't got hurt. They're good. There's no denying it.
Yeah, when they're in rhythm, they're a machine. They've mowed through some teams this year. But Chiefs also got the Mahomes.
We do have Patty. We got Travis.
So
Chiefs have been here before.
They have. So it should be a great game. So wishing every listener out there, I'm guessing the majority of you will be checking out the Super Bowl, the big game, whatever marketing term you're supposed to use, you don't get in trouble.
Yeah.
You'll be on it. You'll be watching it. I know you and Kate will be in separate rooms. I'm kidding. I think it'll be great that you'll be hanging out with friends. And the rest of the team is going to carry us next week on the podcast. It's going to be awesome. But this was a 150. I think this is a great round number. And there's even greater things to come. So we appreciate everybody listening. Of course, give us a great rating if you like these. Share it with your fellow advisors and friends or clients or whatever. Help us get the word out. We appreciate it with that.
Buy the ETF.
Or do that too. We appreciate it. Take care.
Have a great weekend, everyone.